Good afternoon, everyone. This is Blake Willis, Chief Operating Officer, July Business Services. I'd like to welcome you to our webinar this afternoon on Secure 2.0. A few housekeeping items before we jump in. We are recording the session today. We will be sending a copy of the recording and a copy of the presentation slides to each of the attendees today. So if there's something that you aren't able to jot down all the notes on, we will be sending you a copy of the slides. I hopefully have allocated time today. I certainly plan to answer questions that come in. So please use the question and answer panel on your Zoom bar or the chat panel to submit questions. And I'll be watching that throughout the session today. Just a quick slide or two about July before we jump into our Secure 2.0 topic for today. For those of you that are not deeply familiar with July, we are a record keeper, third-party administrator, an advisor-centric firm. Everything we do is partners with an advisor like you. We don't compete with you in any way. We've got a dozen on our sales support team to help you with prospecting, plan designs, illustrations, anything we can do to help you, again, with prospecting and pursuing new opportunities. For those of you that are call yourself newer to the retirement space, we're happy to teach and train you. And for those of you that are experts, certainly we're here to be a resource to you as you have opportunities. Maybe it's more complex, deep consulting that you need on opportunities, or maybe it's defined benefit or cash balance opportunities that are more complicated. We're here to help you on those types as well. What July is really known for, though, is our dedicated sales setup and ongoing service, and just the way we work with advisors and your clients and plan sponsors on that very hands-on basis. A little bit about July. Again, we've now grown to almost 8,000 plans that we service, about 170,000 participants, over 10 billion in assets, working with more than 2,000 advisors across the country. Again, I mentioned our service aspect, but other things that we're known for are our products, our technology, and an innovative side. So anything we can do to help you. Certainly today is about education, but anything on about prospecting, again, whether it's plan design, fees, technology, we have products that are very simple, one participant plans and pooled employer plans, very, very simple turnkey plans, to much more complicated, customized types of plans, even defined benefit and cash balance. So again, whether it's a small business, a large company, want a very turnkey product solution to something very customized, we are here to help you. With that introduction, we talk a little bit about that topic for today. I'm sure most of you are familiar with the Secure 2.0 rules that we had come out on December 29th, 2022. We all had just a great post-Christmas reading all of the new rules that came out. In some cases, rules that were effective 3 days later on January 1, 2023. They followed that up with the IRS issued some additional, what they called grab bag of Secure 2.0 updates on December 20th, 2023. So just about 1 year later, Merry Christmas once again, Happy Holidays. Here's some more reading for you. But we were thankful for that because a lot of questions from Secure 2.0 from December of 2022. Certainly some of those were answered in the additional grab bag of answers that we received in December of 2023. But as we'll talk about today, many questions do remain. We will need more than just the grab bag that we got in December 20th, 2023 to know, more provisions, more regulations around many of the Secure 2.0 items. But what we want to talk about today, again, I'm going to take the highlights. of Secure 2.0. There were some 90, I think it was, items. Obviously, we're not going to be able to cover all those today, but hopefully I picked out a highlight of things for us to talk about, that the places that we're getting the majority of questions from advisors and plan sponsors. All of these changes, as you'll see, I put a date, an effective date on each of the pages that we'll talk about, each of the different Secure 2.0 changes. So again, some of them were effective immediately. We have some that aren't effective until 2027. And so we'll talk about the effective date to kind of help you focus on the things that clients or maybe want to hear about right now. I also want to prioritize some of the things that obviously have a big impact, we think, on plans. Many of the provisions, again, we're not going to cover all 90 plus of them today, but many of the provisions will certainly have a much smaller impact. So first question we're getting, in fact, I got it today from an advisor. It was a question about terminal illness distributions, which we'll talk about. This company wants terminal illness distributions. Can we amend their plan? The answer is no, we cannot amend their plan. But the good news is we can operate in accordance with the new Secure 2.0 rules, even though an amendment is going to be adopted at a later date. Originally, that amendment was going to have to be adopted by 2020, end of 2025. On December 20th, 2023, part of the grab bag was they've already delayed that another year until December 2026. So all the things that we're going to talk about today, if you want to have it in your plan, you can operationally comply with that whenever it's effective. We just have to amend the plan by December 31st. Most plans, it's December 31st, 2026. There are some other types of more specialized plans like government plans and things like that that even get a later date. But for most plans that we deal with, December 31st, 2026. But we'll have a retroactive date in that amendment back to the effective date of that provision. We'll talk about some provisions today that are mandatory. Obviously, those are going to go in the amendments. We'll talk about some that are optional. I'll comment on the optional ones about the position that July is taking on those optional provisions and how, if you have, I mean, I'm sure by now you've seen the communication that we sent in late 2023 about these new provisions, particularly the ones becoming effective in 2024, the distribution provisions, most importantly, and the default position July is taking on each of them, because obviously your clients will then receive that default position unless something different is communicated to us. And so again, I'll mention those on each of the different slides as we talk about the topics today. Unfortunately, we're going to start here. Long-term part-time employees. This is probably the most complicated. It's certainly one of the more complicated areas. It's certainly the area that we're getting the most questions about from clients. So let me talk a little bit about this topic. This one is mandatory. Plans cannot choose not to comply with the long-term part-time employee rules. It affects 401k and ERISA 403b plans. Part of the complexity is that there are different rules for 2024 and 2025 and forward. That is because when we had Secure 1.0, it laid out one set of rules for long-term part-time employees, and then Secure 2.0 gave us a new set of rules for long-term part-time employees that would become effective in 2025. So we're stuck with these Secure 1.0 rules for 2024. Then for 2025, we changed to the Secure 2.0 rule. So let's first talk, what is the 2024 rule? And also we'll talk here about what has July done to help clients. So for 2024, this only applies for 2024. An employee that works 500 or more hours in the years 2021, 22, and 23, only those years, must be allowed to defer into the plan effective January 1, 2024, if they haven't otherwise met eligibility for the plan. If your plan has immediate eligibility or 3-month eligibility or 6-month eligibility, and these people are already in the plan, then certainly they're already allowed to defer and you're good. But if your plan has a 1-year, 1,000-hour requirement, for example, then this employee working more than 500 hours but less than 1,000 hours has not entered the plan. If they worked 500 or more hours in those 3 years, even though they haven't met the eligibility requirement of the plan, they must be allowed to defer in the plan. again, for those 3 years only, we only look at those 3 years, and it has to be all 3 years. They can't have worked it in 21 and 22, but then had a break in 2023. It has to be 500 hours in all 3 of those years. And again, we don't care about years prior to 2021 for this purpose. They're allowed to defer in the plan. They are not required to receive employer contributions or to count in any of the testing, the ADP, the coverage testing. However, they are counted in top heavy, but that will only help us. But they won't hurt us on an ADP, ACP, or coverage test. Now, can you choose electively to give them employer contributions? Yes, although the default in the plan document will be no, they do not receive any employer contributions. Matching, profit sharing, even safe harbor contributions, which we typically think about like a safe harbor match. All employees that are eligible and defer in the plan get to receive the safe harbor match. That is not the way it will work for the long-term, at least by default. That's the way we're defaulting for the long-term part-time employees. Now, again, that's the rule for 2024. Once we get to the end of 2024, we now shift to a new rule for 2025. And that is that if employee works 500 or more hours in 2 consecutive years, they must be allowed to defer. So first of all, they couldn't be eligible for the plan just meeting the eligibility requirements. Secondly, they wouldn't have been eligible under the 3-year rule in 2024. But if in any 2 consecutive years they've worked 500 or more hours, then they will be eligible January 1 of 2025 to defer. Again, they will not be required to receive employer contributions or be on the ADP, ACP, or coverage test, but they will count in top heavy. That is the default. One question that has come up that we got a little bit of clarification on is, what if my plan has excluded classes? What if my plan excludes interns? What if my plan excludes employees that work in a certain division? Can those remain as exclusions? And the answer is yes, as long as the exclusion is not a proxy for covering part-time employees. In other words, you can't have an exclusion of, we exclude part-time employees, or we exclude employees that work less than 500 hours, that work less than 1,000 hours, or something like that. So as long as it's not a proxy for that, and you can still pass the coverage test, excluding those people, then you can continue to have the excluded classes in your document. Let me also mention what July has done to help clients identify participants that may be affected by this. For plans, oh, great. In fact, I see a question coming in. What's July doing to help clients? So what we did in December of 2022 is we ran a query across our database for all clients that were not eligible for the plan, but based on information we had received, did have 500 hours in 21, 22, or 23. Now, at that point, we didn't have everybody's full 2023 census. And so if there was any partial information based on hours in 21 and 22 that led us to believe that a participant, if they had more than 500 hours in 21 and 22, that they could be possibly have 500 hours in 2023, and so therefore might be eligible to defer January of 2024, we sent a notification out to plan sponsors, copied you as the advisor, notifying those clients about the individual participants. We provided the names of the individuals that we said, we believe these employees may be eligible to defer into your plan January 1 of 2024. Obviously, here's the information we have. Here's the information we're lacking based on hours. But here's the rule. If they've worked 500 hours in 21, 22, and 23, they're going to be eligible for the plan to defer into the plan, regardless of your eligibility provision in your document, January 1 of 2024. So we have notified clients. If they were a 316 client, means we were doing the administrative 316 work, we automatically made those new employees eligible. I say new employees, those employees that had met the 500-hour requirement in those 3 years, we automatically made them eligible for the plan, sent out notification to those employees about their eligibility to defer into the plan prior to January 1, 2024. If it was a non-316 client, we provided notice to the clients and told them to let us know whether that employee was eligible for the plan under the rules or not. A few questions have come in on this, so let me take them. And just to confirm, employee is not required to receive employer contributions, but the employer can voluntarily match or profit sharing. That is correct. They are not required to receive it. If an employer wants to voluntarily give the match or profit sharing, they need to notify us because we need to write that into their plan document. So I would say it's more than just, quote, voluntarily giving it. You don't want to just make that decision at the end of the year. You can't just make that decision at the end of the year. You have to write it into your plan document that we are going to give these employees a match or a profit sharing, make them eligible for safe harbor match or profit sharing. Another question, what if July doesn't have the hours for all of the employees? If we had gaps in the information, we included those participants out in our communication to the plan sponsors, notifying them, we are missing hours information for these people. Please verify with your records whether they worked more than 500 hours in 21, 22, or 23, so that we can make the correct determination as to whether they're eligible under the long-term part-time rules, January 1, 2024. The next question says, if a long-time part-time employee is eligible January 1, 2024 and did not get offered the deferral enrollment until February 1, 2024, is there a missed opportunity? Is there a missed deferral opportunity? And is a correction required? The answer is yes. There is a missed deferral opportunity. A correction is required, which is funding the missed deferral opportunity along with any lost earnings to that participant. So that highlights, I appreciate the question, that highlights the importance of the accuracy of getting these people in the plan and getting them in January 1, 2024, because there are missed deferral opportunities, plan sponsor having to pay out, potential errors for clients that are not given the opportunity to defer timely. Another question that came in, I have a potential new client that has some contract employees that work over 500 hours. Does it look back to the date the plan, does it look back prior to the plan start date? They're 1099 contractors. I'll answer this two ways. First, I'll answer about contract workers. Contract workers don't count. We're only looking at W-2 employees, so I'm not looking at contract. 1099 employees, contractors do not count. I don't have to worry about their hours at all. But it does, there's a kind of an interesting second question in here. What if the plan started in 2024 or started in 2025? Do we look back prior to the plan's start date to look at the hours? And the answer is yes. We do have to consider hours prior to the start date of the plan. So if you started the plan in 2024 or even 2025, they're gonna have to look back at the hours, prior hours for 2024 plan, look back to 21, 22, and 23. When you start that new plan in 2024, if a person worked more than 500 hours in 21, 22, and 23, they'll be eligible as a long-term part-time employee. Another question that has come in, what if a person comes in as a long-term part-time employee, but then later works enough hours to meet the full eligibility requirement? What happens to that participant? The answer is they're no longer considered a long-term part-time employee. They're now a fully eligible employee, now subject to all the normal requirements. So they're not going to be able to just defer. They must then receive whatever employer contributions are allocated and they're eligible for. They are counted then in the ADP test and the coverage test as a full prior long-term part-time employee, but now a fully eligible employee. So it is possible for an employee to begin in the plan as a long-term part-time or LTPT employee and then shift to a fully eligible employee. Let me see if there are any other long-term part-time employees. Again, good questions here. We are getting a ton of questions from clients and advisors about the long-term part-time employee rules. So that's why I put it here first, because I expected there'd be a lot of conversation about this point. But I think we've covered all the questions there. If you have questions about any existing clients with July, feel free to reach out to your client service manager. We've got a list of all the employees and their hours information that we have sent out to the clients, and we're happy to share with you the historical information we have, the determinations we've made, or what we've determined is why someone's not going to be in the plan as a long-term part-time employee at this time. I'll mention one final point here and then move on. It is our plan to continue doing a long-term part-time employee evaluation toward the end of each year. So toward the end of 2024, we'll do that again to reach out to clients prior to January 2025 to help them know about clients that might be eligible for the plan January 1 of 2025 under the new 2 consecutive years of 500 hours or more. Okay, moving on here. And I do see the question that says, will we get copies of the presentation? The answer is yes, we are going to send copies of the presentation and a link to the recording to all of the attendees today. The second topic I want to hit is automatic enrollment. This is probably the place we're getting the second most number of questions. And the rule for automatic enrollment is any new 401k or 403b plan established after December 29th, 2022 is subject to these rules. Any plan but prior to that date is not subject to this rule. The date that matters is the day that you execute the document. So if you have a plan that's effective January 1, 2023, but you signed your document by December 29th, 2022, you're not subject to this rule. If you started a plan, let's say you called in 2023 and retroactively set up a plan back to 2022. You didn't sign your document by December 29th, 2022, even though it has an effective date prior to December 29th, 2022. Again, the point I'm trying to make here is the effective date doesn't matter. It's the day you sign the document that matters, whether you're subject to this rule or not. A couple of clarifications we've gotten. If you're joining a PEP or a MEP as a new sponsor, you've not had a plan before, you are a new sponsor after December 29th, 2022. You don't get to say, well, the pooled employer plan I joined started 3 years ago, so it was established prior to December 29th. You are a new adopter after December 29th. You signed into the PEP after that date or the MEP after that date. You are subject to this automatic enrollment rule. If you have a spinoff or a merger or acquisition, you are grandfathered in if the original plan was established by December 29th, 2022. So if you have a plan that splits into two in 2024, two entities were sponsoring a plan and they split off in 2024, as long as that plan, again, was adopted by December 29th, the spinoff is not part. If you acquire a business that's joining you, that, again, the original plan is what we're looking at. Now, what's interesting is this is for plans after December 29th, 2022, signed after that date, but you don't have to add automatic enrollment until 2025, by January 1 of 2025. So let's say a new client calls today and said, we'd like to start a startup plan for 2024. Well, they're starting a plan after December 29th, 2022. So they're subject to this rule, but they're not required to have automatic enrollment until 2025. So we can operate the plan in 2024 without automatic enrollment, and then go ahead and write into the document today that automatic enrollment is going to start in 2025, because it must do that. This is not an optional provision. This is mandatory for all new plans after December 29th, 2022. Again, just to make sure we're all on the same page, the idea of automatic enrollment is that an employee will automatically be deferred into the plan when they're eligible, unless they opt out of the plan. You must start the automatic enrollment, automatic deferral, somewhere between 3 and 10%, and it must have an escalator a 1% minimum 1% per year escalator up to somewhere between 10 to 15% to meet these requirements. So you cannot start automatic enrollment at 2%. You cannot start automatic enrollment at 8% without an escalator. You must start between 3 and 10, and you must have an escalator between 10 and 15, beginning in 2025. What we're recommending is highly encouraging all startup plans now, after December 29th, 2022, go ahead and add automatic enrollment day one, because we have to have it by January 1, 2025. And while you don't have to have it today, it's just going to add complexity to turn around in a year from now and add automatic enrollment to the plan. Now, let me finish this by saying there are a few groups that are exempt. If you have less than 10 employees, you're exempt from the automatic enrollment requirement. Until you have more than 10 employees, then you are subject to it. And employers that are in existence for less than 3 years are exempt from the automatic enrollment requirement. Until you've been in existence for 3 years, then you're subject to it. Again, because it's likely that many of those new and or small companies will stay around for 3 years or grow more than 10 employees, we are again recommending and encouraging all new plans, regardless of their new existence or they have even less than 10 employees, to go ahead and have automatic enrollment added to the plan, just so it's not something that, you know, they miss a few years down the road and, oh, we didn't realize we went over 11 employees. Nobody remembered it was after our 3 years of existence and we forgot to amend the plan to do that. Again, while we're highly encouraging that now. A question came in. Just to confirm, older plans are not required to make auto enrollment at any point in the future. That is correct. This slide is only for new plans after December 29, 2022. The way that it is, the way the rules are written now, and possibly we could get new, legislation at some point that might mandate it for even existing plans. But right now, the rules are, if you signed your plan up prior to December 29th, you are not subjected to this now, in 2025, or at any point, as of now, in the future. Another question that came in, you'll notify plans that started after 2022. Yes. In fact, one of our things our sales team is doing, every new plan that they're setting up, they're having this conversation about add automatic enrollment to the plan, highly encouraging them to do it. And if they don't, we're reminding them, you must do this by 2025. Another question, does July automatically track the employees that should be automatically enrolled? Yes, if it's a 316 client, we're automatically tracking those employees. In fact, we're taking that a step further. We're automatically reaching out to those employees, not just to the employer and the sponsor, but we're automatically reaching out to the employee to notify them prior to their eligibility date, their automatic enrollment date that they come and are eligible to defer into the plan. And since they're automatically enrolled, if they don't make then an election, we're then ensuring that the payroll gets set up. We're communicating back to the payroll company or back to the plan sponsor to ensure this employee is now automatically enrolled. They didn't make an election. We need them in at 5% or whatever the automatic enrollment is. Let's see. Another question says, can an employee change the amount of the automatic enrollment to grow each year without it affecting a plan? Can they start at 3%, grow to 4%, and only want it to stay at 4%? Yes. This isn't mandate. Nothing about this rule mandates what an employee can do. This just mandates what we do if an employee does nothing. Any employee can take control of their account and elect 0 or 3. Or this example, can an employee elect to grow to 4 and then stop at 4 and not have automatic increase from there? Yes. This just tells us what to do if this rule just tells us what to do if an employee does not take any action to elect to opt out of the plan or to set their own deferral rate. They will come in at the automatic enrollment percentage and grow 1% up until whatever the rates are in the document. Again, until they tell us to do something otherwise. Put them at 0, stop increasing them. They enter their own deferral amount, whatever that item might be. Okay, so that covers us on automatic enrollment. I'm just looking here. I don't see any other automatic enrollment questions. So let's move on to our next topic, catch-up contributions. This is a mandatory provision effective January 1 of 2025. And the way this new requirement is that if you have catch-up contributions in your plan, the catch-up limit will be higher for those age 60, 61, 62, and 63 than for all other catch-up eligible participants. Let's just set the stage here. We all know that at age 50, you get a catch-up contribution. You can put in $7,500, and any age past 50 and older. Well, what's going to happen now is between 50 and 59, you get the $7,500 or whatever the limit is that year. But the year you hit 60, 61, 62, and 63, you get an even higher catch-up limit, the greater of 10,000 or 150% of the regular catch-up. So just to put that in perspective, 150% of 7,500 is 11,250. If this were available in 2024, it's going to be $11,250. Again, it's not effective till 25, but the catch-up for 60, 61, 62, and 63, again, greater of 10,000, or in this case, 11,250, it'd be 11,250. Those limits are indexed with the deferral limits every year. And then at age 64, you go back down to the regular $7,500 catch-up limit. So 7,500, 50 to 59, up to a higher limit, 60, 61, 62, 63, back to age 60, 64, and later back to the regular, what is now $7,500 catch-up. So higher catch-up limits, but only for those 4 years. Let me partner that with the other item, which is where we've gotten a lot more questions around this, and that is the Roth mandate for catch-up contributions. This was originally supposed to be effective in 2024, but the IRS got significant pushback and delayed it until 2026. This is a mandatory provision. If your plan allows catch-up contributions, you must comply with this Roth mandate, all 401k and 403b plans. And here's the rule. If a participant that makes $145,000 or more per year, in the prior year, a participant made if an employee made $145,000 or more in the prior year from that employer, working for that employer, then if they make catch-up contributions in the current year, those catch-up contributions must be funded as Roth, regardless of what the participant is elected for their original contributions. So if a participant makes less than $145,000 in the prior year, then they can make catch-up contributions of pre-tax or Roth, however they want them. If they make more than $145,000 in the prior year, but working for a different company, let's say they're a new employee and last year they worked for some other company. Well, they didn't make $145,000 last year with your employer, so they are not subject to this rule. This is only for those that made $145,000 a year, and again, that limit's going to be indexed every year. In the prior year from that company, they must make their catch-up contributions as Roth. There are some administrative challenges here. Some of them we got answers with in the grab bag, but there are still a lot of information, questions remaining. What if your plan doesn't have Roth? If you have catch-up contributions, you'll be mandated to have Roth, because any catch-up contributions like this must be funded as Roth. Some other rules: the taxation of this. How is the taxation going to be handled? Because we have, what if payroll doesn't know that this employee, let's say this employee elected pre-tax, and they've now hit the catch-up limit. Is payroll going to catch that this employee need to be shifted over? to Roth? Probably not. And so we actually have to prepare a 1099. This is not going to be a W-2 item. One of the answers we got in the grab bag is the taxation of this is going to be dealt with by the plan, not by payroll. This isn't going to be a W-2. Now, if they withhold tax, that's great on the payroll side, but it's going to be a 1099 reported for these designated Roth contributions for catch-up. And we're going to get to a minute also the employer contributions. Now, employer contributions can be Roth and how that needs to be dealt with the 1099. But I say all that to say there are some administrative challenges here. The taxation of it is going to be an issue that we still need more answers on. Payroll is going to have to help us with this. I think there's going to be a lot of corrective issues that have to happen because payroll is not going to know on how to do this. So a few questions here on catch-up contributions that have come in. Is it the calendar year that someone attains age 68, 61, 62, 63? Yes, it is those 4 calendar years, just like age 50. It's the calendar year of turning age 50 that you're eligible for catch-up. So you could actually make this catch-up contribution when you're 60 prior to even turning age 60 because it's the year you turn 60. Yes, it is 4 years, ages 60, 61, 62, and 63. So those 4 years. A question came in, are contributions recharacterized as, what about if contributions are recharacterized as catch-up? Like you fail an ADP test and you have to get recharacterized as catch-up. What do you do? Obviously there's a tax problem there, and that is what's going to have to happen. If you fail the ADP test and a person made pre-tax deferrals and those deferrals have to get recharacterized as catch-up, they now must become Roth, and we must make them Roth, and now the participant must pay tax on those dollars. Obviously, that's already run through payroll. Many months ago, that's run through payroll and dealt with. We're going to have to deal with the tax on the back end. What if your plan doesn't have Roth? Then you can't have catch-up contributions of this variety. And so one of the things we're going to be doing, since this is effective in 2026, one of the things we're going to be doing in 2025 is reaching out to every plan that has catch-up, that allows catch-up contributions but doesn't have Roth, to tell them they need to add Roth as a provision in their plan if they continue to have, if they want to continue to have catch-up contributions. Here's another question that came in, kind of back to my earlier comment. So participant would pay taxes on Roth catch-up after the year end when they file their tax return? That is right. There's going to have to be tax. And again, I mentioned the last bullet point. Some complex administrative issues and questions remain. This is one of them. Now, how are we going to go back and do that when we have recharacterized and fail an ADP test after the end of the year? But now this is back in the prior year. How are we going to deal with the tax issues from prior years? We need more answers from the IRS about how that is going to happen. Another kind of generic question that came up, and about all the things we've talked about. Do these rules affect solo plans? The answer is yes. These catch-up contributions, all the provisions we're going to talk about today, I think I can say that without exception, are going to affect solo plans as well. In fact, I probably should have mentioned on the long-term part-time where we started. We know that we have a lot of solo K clients, individual K clients today that have part-time employees that maybe even work more than 500 hours. In fact, we know they do. That solo plan is now going to not be a solo plan anymore in 2024, because if they have an employee that worked 500 or more hours in 21, 22, or 23, that employee is now eligible to defer. With an employee that's eligible to defer, they are technically no longer a solo plan. So solo plans are definitely something you want to watch out for. If they have any part-time employees, we need to be very concerned about the long-term part-time rules for our solo K clients. But yes, catch up and all the other things that we're going to talk about do affect our solo K clients. Okay, with that, let's keep moving. Our next topic is our next several slides here about distributions, all the new distribution options. In fact, there's several slides here about new distribution provisions. Most of them are optional. This one is mandatory. Required minimum distributions, RMDs. Many of you will remember the old 70 and a half age requirement when we paid RMDs. This changed, well, some time ago, we changed from age 70 and a half to age 72. This rule now changes it to age 73. So effective immediately, back to when this was released in December 2022. So in fact, for all of 2023, we've been dealing with the age 73 rule for required minimum distributions. So that's the age to know right now. Now, you're going to stick with that for about 10 years, and then you're going to forget that because in 2033, they've already notified us that the age is going to increase to 75. So what was 70 and a half several years ago became 72. Last year became 73. Will then stay that way until 2023, 10 years or so, when it will then be increased to age 75. So that's the most important thing to know. The other kind of important bullet point here is the excise tax. And this is kind of an interesting one. So you may be familiar, if you miss a required minimum distribution, you can apply, you can submit a form and apply for a waiver of the missed RMD penalty. That missed RMD penalty is up to 50%, an excise tax of 50% of the missed required minimum distribution. Obviously, that is a huge penalty to have. So what we would always recommend to clients, fill out this form, go to the IRS, and many times, very successfully, we were able to help clients get that that 50% excise tax completely waived. So it's been, while we've had a pretty bad rule with 50%, we've been able to get it waived. Well, here's what's happening now. That excise tax is dropped from 50% to 25%. Okay, I like that. And even if you fix it within 2 years, it drops down to 10%. I really like that. But here's what I think is the silver lining. I think the IRS now is going to no longer waive a bunch of excise tax by sending that form in that we used to send in before to get the excise tax completely waived. I think that I would not be surprised if the IRS's position now is we've dropped the excise tax to a more reasonable amount, 25%, or in many cases, 10%. So we're not going to accept any of these excise tax waiver forms anymore like we used to because the penalty was so significant at 50%. So more to come. We'll see how less lenient they are on this excise tax waiver. But I guess overall, fairly good news that they've dropped the penalty down to 25, or in many cases, 10%. If you miss a required minimum distribution. Next is emergency distributions. Again, I'm going to talk all the distribution provisions kind of back to back here. This one is optional. It's effective right now in 2024. July is prepared and processing these types of distributions today. Emergency distribution allows one penalty fee withdrawal every 3 years for up to $1,000 for, quote, an unforeseeable immediate financial need related to personal or family emergency expenses. So an employee can self-certify that they have an unforeseeable or immediate financial need. They don't have to provide any documentation. And again, they can get one penalty-free withdrawal every 3 years. This is one that we have put in as a default. If the plan has hardship distributions, we are allowing emergency distributions. Any of these optional provisions, if a plan sponsor doesn't want it in their plan, they just need to notify us and we will opt them out. But again, our default, which I'll reiterate on several of these slides here, if the plan has hardship distributions, they now have emergency distributions also allowed. Remember, we're not going to do an amendment, a formal amendment to the plan until 2026, or we're going to operationally comply that the plan has emergency distributions if they have hardship distributions. And just to make sure I'm very clear there, if a plan doesn't allow hardship distributions, then by default, they are not going to allow the emergency distribution option. We're just following the election that they've taken for hardships. Similarly, domestic abuse distributions, following the election that the plan has on hardship distributions. Effective in 2024, is effective right now. a penalty-free early withdrawal, penalty-free meaning no 10% early withdrawal penalty in the case of a domestic abuse, and the participant can take an amount not to exceed the lesser of $10,000 or 50% of the vested account balance, the lesser of those two amounts. Again, participant can self-certify that they have a domestic abuse situation and do not provide any documentation, and they can take a distribution out. This one you'll see, and you're going to see a common theme here with all the distributions. The IRS is provided many more avenues for participants to take money out without the 10% early withdrawal penalty. That is obviously a revenue hit for the government. But I'll go back a minute to the Roth. In fact, I'm just going to go back in the slide here. The catch-up contributions, mandatory Roth, this is the revenue offset for all the things we're going to see in Secure 2.0 that are revenue reductions. This one is a revenue generator for the government. That the way the government works, they have to show that they are raising enough revenue to offset the decrease in revenue. That is why we now have Roth, or beginning in 26, we'll have Roth mandatory catch-up contributions. The revenue gained by taxing those catch-up contributions more than offsets all the government has estimated, all these tax reductions for all these new distribution options we have where they're waiving the 10% early withdrawal penalty. Okay, so that's domestic abuse distributions. Let me go to the next type of distribution, federally declared disaster distributions. This one is optional. Again, we're going to follow the hardship provisions. This one is effective immediately. A participant can get up to $22,000 per disaster, can get increased loan limits up to $100,000, longer repayment periods on loans, not subject to the 10% early withdrawal penalty. And then the participant can spread the income over 3 years. So they could take out a $22,000 distribution, but choose to take that as reported as income over 3 years. So spread it out as, $7,000, $8,000 a year in year 1, year 2, and year 3 to pay tax on it spread out. Participants can even recontribute the amounts that they take as a distribution for up to 3 years. So you could take a federally declared disaster distribution if you're in a federally declared disaster area, and then within 3 years of taking it, pay it back and recoup the tax implication, so that you don't have a negative tax impact on your account. Terminal illness. This is an optional distribution provision that we are aligning with an in-service distribution. A couple of things here that are important, that are different than the others that we've talked about. This is effective immediately. This is one that a participant cannot self-certify. A participant must provide certification from a physician that their illness or condition is reasonably expected to result in death in 84 months or less. The other things that we're talking about, the IRS is moving much more to a self-certification model for distributions, emergency distribution. We're going to talk about hardship distributions, self-certification in a minute. Domestic abuse distribution, all those can be self-certified. This is one that cannot be self-certified. But another place that a participant can take, have another distribution option where they're not subject to the 10% early withdrawal penalty. One other important point on terminal illness that we got as part of the December 20th, 2023 grab bag guidance is that a participant must be eligible for some other type of distribution in the plan in order to take a terminal illness distribution. They can't just be eligible for a terminal illness distribution. They have to be eligible for a hardship or in-service or some other type of permissible distribution option to be able to then qualify for a terminal illness distribution, to be able to get, the subject to 10% early withdrawal penalty and all the other things that getting terminal illness can do that's if you will, better than a hardship or an in-service distribution. Hardship rules, these are optional, but we are, again, defaulting all clients to this, effective in 2024, so effective right now. The 403B, if you even knew that the 403B and 401k hardship rules were slightly different, we're aligning now under the 401k rules. But the biggest change is we're now self-certification for hardships. As you may know, in the past, we required plans participants to provide a copy of an eviction notice, to provide a contract for purchasing a principal residence, to provide medical bills, to provide post-secondary education bills, to be able to certify that they had a hardship. Participants are no longer required to do that. We are taking the position that we're going to allow participants to self-certify. So if a participant says, I have medical expense, I have post-secondary education expense, I have prevent eviction from my home, I have purchase a principal residence, or whatever the other hardship distribution options are, they can self-certify that, providing no documentation, and they can be eligible for a hardship. Let's see, going back, there's a few questions coming in on terminal illness distribution. Question says, will it have a different, basically, we'll have a different code, 10 code for a 1099. Yes. We don't have the details of what that code will be, but I expect it will be a different code on a 1099, again, to ensure the proper tax treatment is done. Okay, with that, let me keep moving on the last distribution provision here, and that is force outs. Again, I had a question about this today. This is optional. We are defaulting all clients to this. Effective right now, what was the old $5,000 cash out limit, we can force participants out, has been raised to $7,000. Of course, our position that we're taking is, why wouldn't a plan want that? More people they can get cashed out of the plans. They don't have to pay for them. Deal with them from a fiduciary, perspective. Have small balances remaining in their plans. So we think this is a great provision. We support this one fully. We are changing all of the $5,000 limits to $7,000. And again, we'll be operationally complying with that. The new, documents won't come out until 2026. One question that came in, and just a general question, not about this specifically. Do we have a trustee? Do we have a piece that summarizing these updates that we can use to educate our clients? Yes. In fact, I believe we're going to be sending that out as part of the follow-up here, but we do have a one-pager, a 1 or 2 pager that is a great educational piece, notifying clients about all of these. Well, looks like we actually have 2 questions that were the same thing there. But yes, we do have a checklist. We have a little a summary, an educational piece that you can share with prospects or with clients. So we'll deliver that as one of the takeaways from this session today. I appreciate that question. We've got just less than 10 minutes left, and we've made it through the most important ones. So I want to kind of just fly through these last 10 slides or so quickly about some other smaller items. Plan corrections. Plan corrections were expanded under Secure 2.0. There are now more items that can be self-corrected within 3 years of failure. Certainly something we support. Self-correction is a whole lot cheaper and easier than going through voluntary correction, where we have to apply to the IRS to get their approval. So we very much support this, and we'll when plans do have issues, we'll be looking at more opportunity to self-correct for those. Actually, I do see another question that has come in. We just talked about all the distribution changes. Will new distribution forms? Yes, the new distribution forms are being created. I believe it's this week that we have released all of the new distribution forms. If it hasn't been done yet, it's within the very few number of days. We have finalized all the new distribution forms for all those new types of distributions that we just talked about. So you'll see updates of those on our website. So appreciate that question. Startup tax credits. There are a number of things in Secure 2.0. If you're working on new clients, this won't affect your existing clients so much, but as far as new clients, this is effective immediately. But there for new plans that are starting, again, startup plans, $250 per non-highly compensated employee tax credit, not a deduction, a credit, a dollar for dollar reduction in your taxes. So for the first 3 years, the old credit was 50%. Now we get a 100% credit if you have up to 50 employees, up to $5,000. So they've doubled the available credit if you have up to 50 employees. If you have 50 to 99, 51 to 99 employees, you still get the old 50% credit for the first 3 years. One question we do get is, what if I started my plan in 2022? I'm still in my first 3 years. Can I go back and retroactively get this? The answer is yes. If you started up a plan in 2022 and you're filing you filed your 2022, or obviously we're more dealing with 2023 now, but that was the answer we were giving, in late 2023. Now we're kind of dealing with 2023 tax returns. But if you started your plan in 2023 or even in 2022, and you're in those first 3 years, you can get the credit available. Now, it must be expenses that the company pays, not expenses that the plan pays. The company has to pay them. But it is available to plans here. A question came in, is this tax credit available to solo K? The answer is no. Notice here that you have to have, this is for non-highly compensated employees. A solo K, by definition, has only owners or highly compensated employees. So this tax credit's not available. I'll change my answer here in a minute. But if you, in fact, I mention it here. There is another tax credit that we have that is for automatic enrollment. The automatic enrollment tax credit is available. There's no requirement that you have non-highly compensated people. Interestingly, even a solo K can put in automatic enrollment and take the automatic enrollment credit. We also have a new contribution credit. This one is brand new, effective immediately. First 5 years of the plan. Again, go back and think. If a plan started in 2020 and you're in your first 5 years, do you have this available? $1,000 per employee of employer contributions up to the amount contributed for the employees. If you have up to 50 employees, you get 100% in year 1 and 2. And then that is scaled down to 75, 50, 25 in years 3, 4, and 5. If you have more than 50 employees, that credit is reduced down further. But we have plans that are starting up today saying, can we fund a $1,000 contribution to each of our employees and then turn around and take a tax credit for the exact amount for our employees for the first few years? And the answer is yes. The government is essentially saying we will cover the cost up to $1,000 for funding an employer contribution to your employees in the first few years. Again, it's 100% of the credit the first 2 years. Then it scales back to 75, 50, and 25%. And then obviously by year 6 down to 0. But in the first few years, the government is covering the cost with a tax credit. Again, a credit, dollar for dollar reduction in the taxes, not a deduction. So any of these things that are not taken as a credit, whether it's the, on the last side, paying expenses to start up a plan, or in this case, the employer contribution, anything you don't take as a credit, you're able to take as a deduction, but certainly a credit's better. Question, do the credits apply to plans started in 2021? For a startup tax credit, if you're in your first 3 years, so 21, 22, 23, yes. Contribution tax credit, you're in your first 5 years, 21, 22, 23, 24, 25, yes. Military spouse credit, a new credit. If you have an employer that does hire military spouses, there's a small credit available the first 3 years, $200 per military spouse plus up to $300 per contributions. One interesting one here that I think is kind of the watch out for is you do have to make them more quickly eligible for the plan, and they have to have immediate vesting to be able to get these credits. A few final things here in our last 3 or 4 minutes. Incentives to participate. We haven't previously been able to give them incentives, but we can now give up to $250 incentives to participate in the plan. What that would look like is, here's a $250 gift card if you're willing to defer into the plan. You can now give incentives up to $250 in value that are taxable to the participant but up to $250 in value to encourage a participant to incentivize them to participate. Notices and statements. We are going to hopefully get, they've been directed, the Treasury and Labor have been directed to consolidate notices, provide an easier notice package. As you all know, we provide a number of notices throughout the year to participants. And so the notice and process hopefully is going to get easier. One strange requirement, though, is by 2026, we have to give one paper statement every year to all participants, even if they've elected to get their statement. I'm hopeful that gets pushed back or it gets canceled, but as of right now, that is the rule. Savers match. The government says that they are going to, instead of doing the savers credit that they do now for lower income participants to encourage participation in the plan, instead of giving a credit on their tax return, they're going to fund a match to the plan on behalf of the participant. This is the one that has the longest effective date. I can't even imagine by 2027, the government's going to get their act together to be able to do this. I see huge administrative issues. This is one not to worry about yet. We'll see if the government comes around and is able to do this. Two provisions I want to mention as we wrap up here that July is not adopting that are in Secure 2.0. And that is the Roth expansion rule that allows a participant to fund their match or profit sharing contributions in as Roth. There are significant administrative issues with this. There's concern about plans have to require 100% vesting, which most companies don't want to do for their match or profit sharing contribution. We have to include an income. I was talking earlier about including an income, reporting it on a 1099-R for the participant. What we're encouraging plans to do that are interested in this type of option is to use the in-plan Roth conversion solution where a participant can move their money from pre-tax to Roth, any money in the plan, which we default every plan to have in-plan Roth conversion to accomplish this, rather than using these employer Roth contribution options. You can get to the same place. A little bit more tedious work, but you can get to the same place. We really feel that it's we need more regulatory guidance before we encourage plans to use this Roth expansion. Similarly, to again, two more quickly here. I know we've just gone over time with lots of questions here. Student loan payments. You've probably read a lot about student loan payments being allowed. At this point, July is not defaulting plans into student loan payment options. But what you can do here, if a company wants to, they can match student loan payments. Employees can self-certify that they have student loan payments that they've made. The employer can treat those student loan payments as deferrals for purposes of making a matching contribution. There is a separate ADP test that's done. Again, a lot of administrative complexity here. A lot of it is around trying to be able to properly gather the information about who has student loan payments to be able to make the matching contributions. So again, this is not one that we're defaulting. If a plan sponsor is interested in this, we're happy to have a conversation and put this in their document, but it is a manual process to do it at this point. And then the last one I wanted to mention, the emergency savings account. Emergency savings account is effective right now, but again, significant administrative complexity here. It allows non-highly compensated employees, in addition to deferring in the plan, to be able to make another Roth automatic enrollment contribution up to 3%, saving up to $2,500 into an emergency savings account that sits alongside their retirement plan. So we treat it like deferrals for purposes of making a match. It's a separate bucket of money. They can save up to $2,500, must be Roth, and the participant can take up to one distribution per month as an emergency distribution that we cannot charge them a fee to take. The 10% early withdrawal penalty on those distributions doesn't apply. And they have to invest that money not in the core lineup of the plan, but must be invested in some lineup in the plan that is cash, an interest-bearing account, or a capital preservation account. Obviously, lots of administrative issues here. So at this point, July is waiting to allow emergency savings accounts inside the plan. We think there are better options, and obviously waiting on a lot more guidance to be able to guide our small business owner clients to be able to offer this without a lot of administrative complexity, both for us and for the plan sponsor to administer. That gets us to the end I know I've answered lots of questions along the way. Let me pause and just check and see if there are any other questions that have come in as we wrap up here. I may not have hit every question, but I think I hit just about every question that has come in to keep us moving here. I don't see any other questions. So let me wrap up by saying thank you for attending. I hope you got a couple of takeaways from today. Hope you learned something new. We will be making, as a reminder, a copy of the recording and the slides available. Let me just give a plug for two things as we wrap up. I mentioned the tax, the new tax credits. We have a tax calculator on our website. If you're working with prospective clients, or maybe you have one of those new clients that started their plan the last few years, I encourage you to use that tax calculator to help a client. It's right there on our main website. It's not behind any kind of login, but just julyservices.com. You can access that tax calculator. It can help a client know how much they can take as a tax deduction. Certainly, we're happy to help them too when they're working with their CPA or accountant filing their tax return about what credit they can take for expenses paid or for contributions funded to the plan. Last plug I'll make, our next webinar this is the end of January. Our next webinar is the end of February. On February 28th, we are doing another webinar that is not near as technical in nature. It's about adding video to your advisor practice marketing mix, how to use video as part of your advisor practice, give you a bunch of pointers and tips on that with Alan Gross with GSM Marketing. If you haven't signed up yet, please do sign up for our February 28th webinar. But with that, let me say again, thank you to each of you for your partnership, for joining and spending an hour and 5 minutes with me today. I hope you found this helpful. Please let us know if you have any questions. Reach out to me, reach out to your client service manager. We'd be happy to address any questions that you have. With that, I'll be signing off. Good afternoon, and have a great rest of the day. Goodbye.